Welcome everyone to today's webinar, Navigating the Current State of Reinsurance Renewals, brought to you by Johnson Lambert. My name is Kim Mobley. Before I introduce my colleagues, I need to cover a few administrative items. First, you can download a copy of today's presentation from the resources window. If you experience any technical difficulty during the webinar, please click the help icon. To engage with our presenters, please submit your questions in the Q&A window. We will do our best to answer as many of your questions during or at the end of today's session. For those interested in receiving CPE CRE credit for participating in today's webinar, you will need to go to the certificate icon. You can launch the certificate window to monitor your progress toward earning your certificate. Once you've met the criteria, you will see a certificate image appear in the certificate window. Click on this image to download your certificate. The only way to obtain your CPE CRE credit is by downloading it through this platform. Credit is not available for group viewing. Johnson Lambert uses polling questions for credit verification purposes. To receive your one CPE CRE credit for today's session, you will need to be present for 50 minutes and answer at a minimum of 3 polling questions. All right, our distinguished speakers have decades of industry experience. Let me give you a brief introduction. Reed Davis is Regional Vice President of McGriff, leading commercial insurance and employee benefits brokers. Reed is responsible for the operations of the Georgia region and offices in Colorado, Minnesota, Oregon, and Washington. He's the real estate hospitality practice leader for McGriff. Reed specializes in complex risk financing transactions, real estate, private equity, manufacturing, and healthcare. Steve McElhaney is Senior Vice President and Director of Reinsurance for Artex globally. His insurance industry experience has spanned over 2 decades. His background in corporate finance and reinsurance provides a unique insight into the recent convergence of the capital and reinsurance markets. Steve is a frequent speaker and serves in leadership and board positions for multiple organizations, including Captive Insurance Companies Association. He's also the author of Fundamentals of Reinsurance and Reinsurance Markets. Their bios can be found in the resources section of your screen. Okay. For our agenda today, what a year. So far, we've seen political and social unrest, a global pandemic, our economy grind to a halt, social inflation is rising, weather events, and wildfires. The industry is experiencing increased loss frequency and severity, resulting in reduced profitability and capacity, rising premiums, and complexity of exclusions. These challenges are expected to continue through 2020 and well into 2021. During these times, the insurance industry is committed to serving policyholders in their communities. The industry has provided more than $10.5 billion in new discounts and refunds to policyholders, expanded flexible payment solutions, suspended premium billing for small businesses, paused cancellation of coverage for motorists due to non-payment and policy expiration, and insurance are also providing aid and helping their communities through meals and funds to local charities and supplies to healthcare workers. Tough conversations are underway to define coverage strategies at a reasonable cost and to deal with underwriting scrutiny. Our agenda will address the complex topic of retail and reinsurance. We'll also cover renewal challenges, feature restrictions, captive insurance, and renewal tips. So to start checking the boxes for CPE, let's get our first polling question out of the way. How difficult was your reinsurance renewal this year? Again, as a reminder, to receive CPE and CRE credit, you must answer a minimum of 3 polling questions. And please remember to push the submit button. All right, just a few seconds and I'll close the poll. Again, how difficult was your reinsurance renewal this year? Very difficult, expected to be very difficult. The second one, somewhat difficult. Third, light. And the fourth item, not applicable or a Johnson Lambert employee. All right, let's show our results. We've got mixed, but mainly we're seeing somewhat difficult or expected to be somewhat difficult. So Stephen Reed, do our polling results align with what you're seeing from the companies you're working with? I guess, Steve, let's start with you.
Sure. Thanks, Kim. Yeah, very much so. We've seen a very difficult 2020 in terms of reinsurance placements, whether they be treaty or facultative. It's a market that's seen stress from a variety of avenues. On the property side, we certainly have had a continuing frequency of storms and cat events over the last several years that have drained capital, and then we also are seeing the impact of COVID, which we track the earnings releases of various insurance companies that are public, and I think over 27 billion of COVID reserves have been set up. So there's quite a lot of pressure, and then separate, distinct from that, the boards of reinsurance companies are putting a lot of pressure on underwriters to pursue more rate, to really pursue a compelling ROE on a pure underwriting basis, as opposed to looking at investment income, which we all know is virtually non-existent in this market. So it's a very tough market, and certain classes of business in particular are very stressed and have a hard time finding capacity. You look at mining risk, you look at geothermal coal, certain industrial classes. It's very tough out there, and finally there's the impact of a shift in capacity. So some large carriers that were providing 100% of programs are now vastly reducing that capacity or non-renewing some accounts. So that's causing a lot of accounts to look for new markets for reinsurance. So it's incredibly busy out there with the underwriters, and we anticipate this is going to continue through the renewal cycle of 1/1 and into 2021 as well.
Yeah, and I don't have a whole lot to add to that around the reinsurance side, but it's good to see that people are aware of the difficulties, because even in the areas that if we would have had this seminar or webinar 90 days ago, we may have said there are a couple of bright spots in the market, which would have been workers' compensation and potentially even the cyber side of the market, which continues to attract capital and opportunities, which you now are seeing those switch to, mainly because the exposure basis, some of those state rulings around workers' comp and the mandatory acceptance of claims in certain classes of business, and the cyber, which I know we were talking about before we got on the phone, with the work from home strategies and the ransomware attacks that have ramped up considerably. The losses that are being paid in this market have made a dramatic change in how people are underwriting some of the risks. So, we'll be talking, I know, later during this about things to do, things to approach, but the awareness of everyone on the call is good to hear, that nobody is expecting it not to be difficult. What we're dealing with is the hardest and most volatile insurance marketplace that we've dealt with in the last 35 years.
Excellent point. And if we move into the retail and just general reinsurance overview, the P&C industry is stable, with affirmations of ratings being the most common action. We're seeing higher underwriting expenses and a decline in insured exposures due to stay-at-home orders and government orders, business closures. Reed, what are your views of the retail insurance industry, and how do you see claim trends, interest rates, political and social unrest affecting the coverage options of your clients?
You led off with your opening comments, kind of layered over all these things that are going on. But what this does is, when you have this much turmoil in what was already a marketplace which was in decline and hardening, it's exasperated a lot of time and energy on the underwriting side. And, I think for a long time, the industry has pushed for transparency and big data use and the things that go on, which don't always tell you the whole picture. But what it's allowed is insurance companies, and again, I may sound a little bit negative toward our own industry, and I'm not meaning to, but what insurance companies have become are a heck of a lot more data-driven versus artistic. So underwriting is a blend of art and science, and how do you approach an individual account versus an industry-wide approach? And right now, because of the data needs and the things that are going on and the pressure in InsurTech to underwrite and create efficiencies, there's a lot of a decline. There's a big decline in the artistic side of a view of each and every client versus an industry as a whole. So, COVID has affected everybody in some way, shape, or form, so you can't expect that not to. Political issues and social unrest are driving things, and what was already a tort system and a legal system where we've seen claims that have blown up where you may not have seen this in the past, and we can't get anything pushed through that. And again, I'm not trying to make it this political, but there's been a liberalization of a lot of interpretations around rewards and people and the social, what you hear about is social inflation. You hear that, $1 million is not that big a deal anymore. Well, that's still a lot of money, especially if the premiums that were being paid were fractional of that. So it's had a very detrimental impact on the liability claims, and anything that has wheels in their business, transportation, has become very politically motivated. You see it, when you turn on your TV these days, you see everybody, whether it's Boy Scouts, mesothelioma, or something out there advertised that there's class action litigation going on. And flip that on the other side with, and Steve made the comment around the property business. It's not hard. A lot of folks tend to forget that what the damage that the wildfires have caused, the hurricanes, the tornadoes, the floods, it may not have affected your business, but it's affected the industry in a very, very negative way. And I'll share one last example of just what's happened into some of the financial underwriting. And I think everybody's aware. It's not hard to remember what happened in the Mandalay Bay situation, where you ended up having ultimately an $800 million settlement for insurance companies, when the premiums that were paid for that $800 million of limits, even in a blended basis, not just for that, were less than $4 million. You can see what the implications are in that situation. So, that's kind of a combination of everything. And now with COVID and the reserves that Steve mentioned, takedowns, are having a significant impact at the time when companies' revenues are going down, payrolls and the workers' comp are down, but the losses may not be, there may not be enough premium to support the historical losses, which is a little bit of a, building on itself. So yes, it's, I just gave you a bunch of good news, but it's going to be very difficult in every line of business as you move forward. And I do believe it's going to trend well into 2021 or through 21 before we start to see a flattening of some of the rate increases.
Yeah, thanks, Reed. And let's switch gears to reinsurance. Fitch Ratings said earlier in September that ratings outlook for companies in the global reinsurance sector will continue to remain negative due to coronavirus claims and low interest rates. The market has entered a hard phase, and COVID claims are likely to remain manageable, but 2020 may be one of the costliest years for the reinsurance industry. So, Steve, what are you seeing as the current macro reinsurance trends?
Yes, I think, clearly COVID's had a very significant impact on a macro level. And then when you look at specific lines of business like event cancellation, that's a line that's had horrendous losses come through from COVID. Wimbledon was canceled at a $140 million loss, so over 10 to 12 billion of just event cancellation losses have gone through the system and into the reinsurance market. So, that's just one case. Definitely we were seeing in our July 1 renewals a lot of active questioning by all the reinsurers around COVID, the trends, what was happening. And, certainly a lot of markets have reported COVID losses to their carriers, to the reinsurers. They may or may not manifest themselves, but, many ways it's being done maybe as a preventative measure for a D&O suit for, the insured, so that's a trend that's happening. But, beyond that, I think really when you look at the casualty side of things, and to Reed's point on social inflation, it is a very significant issue. And, 3-4 years ago, we would find when we were placing, say, a $250 million reinsured tower, that top layer of, say, $25 million next to 25 would be oversubscribed. The reinsurers would be lining up for it because they viewed it as being so far out of the money, so to speak, that they would opt to put their capacity there in a softer market. But in this hard market, those top layers are in many cases not being filled. The reinsurers are deciding to put their capacity lower, where they're going to get more intensive premiums. And quite frankly, if you're reinsuring a $25 million casualty layer, and even if the premiums are going from $400,000 to $1 million for that, you take one loss, it puts a reinsurer in a position where it's incredibly hard to make that back over a portfolio. So the high layer excess programs are very much compressing across the board. Some industries, it's a particularly tough proposition. Anything in transportation is very tough right now. I mentioned earlier geothermal coal. That's a lot of capacities moved out of that. So the macro side of things, and we look at new capital coming in. It's not filling the gap. There's, I think, only $15 billion of new capital that's come in so far to either ILS or companies. And so the way to get there is really through pushing rates and better risk selection. Speaking from the reinsurer standpoint, and a lot of accounts are finding they're distressed. They're finding capacity. It's particularly if you're loss affected and you have you don't have a strong story in terms of data to present to the reinsurers, that's going to be an enormously tough placement. So I guess when you look at reinsurance as driving the market generally for pricing, there's still a lot of distress globally, and it's a global issue with COVID and other factors. And it may turn out into the day that the COVID reserves were very aggressive, and the actual losses may not reach those levels, but nonetheless, you've had $27 billion of posted reserve increases from public reinsurers just for COVID. So it's quite a different market we're in right now.
Yeah, and a couple of things, Steve, to add to that, and I don't know how much technical we want to get into this, but there's a couple of terms, especially if there's any publicly traded companies or the D&O and some other areas where historically, as you've built limit or started with a $10 or $15 million primary, you're going to be starting with $2.5 to $5 million, and then when it used to be each layer above it was at a 40 to 50% of the layer previous. And now what you're getting is 60 to 75%, and even in some of the high levels, as you mentioned, excess, where you're inverted the pricing, where it may be more expensive than the layer below just to buy capacity. One of the things that comes up on the capitalization, I think is a very interesting thing, is people tend to forget that the insurance marketplace is a capital market. So people are looking for returns and opportunity to make money. And so they got to look, and when you start posting the losses and reserves, you can. And this year, there's been very little new capital come in. There's been some consolidation. So the capitalization of the entire insurance industry is only $850 billion. It's not even $1 trillion industry, and it is a finite amount. And people often think that insurance has an infinite amount of money to pay claims, and they don't. And that's one of the reasons I think you saw such a big pushback and fear of what COVID could do to the industry, because that's a multi-trillion-dollar event. And when we talk about that kind of money, it will decimate and destroy the industry as we know it, which means everybody's going to pay more, because it is it's predicated on sharing and spreading a risk. So it's an interesting dynamic that we're dealing with.
Excellent discussion. Now let's talk about the various lines of business. One of the top news items for property coverage, and you just mentioned it, is business interruption. Several states have proposed legislation that would require business interruption policies to cover claims based on coronavirus, even if there were specific virus exclusions. To date, they've generally not been successful, and there have been several proposals for victim recovery funds similar to those established after 9/11, like COVID-19 Business Employee Recovery Fund. But with the upcoming November elections, and a comprehensive federal response is unlikely in the short term. So, Reed, do you feel the threat of legislation to nullify business interruption exclusions is real? And what are the implications for the property cast or the insurance segment?
Well, I can give you an update as of today on something that happened in North Carolina yesterday, where it was the first judicial ruling in favor of a policyholder in a group of restaurants that were ruled that a judge did rule that COVID should be covered for physical damage BI. So that is the first one we've seen. Up until this point, other than a few lack of dismissals or for summary judgment, everything has been ruled in the insurance company's favor, that these were not contemplated, did not cause physical damage, and some of the other things. So I just thought I'd put that out to you, because I think everybody that has one of the claims, and I know Johnson Lambert probably has a lot of clients that are trying to figure out what their losses are. We're going to probably see this heat up pretty quickly now. But on the other things, as you relate to political and legislative, the legislation is going to drag until we get through this election, and I think you'll see, depending on how it plays out, there'll be some time before, obviously, if you get a more liberal environment, then there's going to be a big push because they were the ones that were pushing for some things going on. But they're all forward-looking, and if there's constitutional challenges on contract and agreement, could be an interesting attack on some of the things that have protected insurance companies. But the other side is just as we relate to the thousands of lawsuits that have been filed and how they do play out in various jurisdictions and where they get rulings on. But it could be a significant implication. We know it's going to be significant in certain states for workers' compensation, where it's been deemed that they have to accept the claims of essential and first responders and healthcare workers, and unless you can absolutely prove that they didn't contract it. Now, on the flip side of that, when you think about this, in these lawsuits, even though they're trying to certify several as class action, these are not going to be settlements where it's just like everybody gets a certain amount of money and you split up the pot, kind of like an asbestosis or one of the mesothelioma funds that you've seen out there. So what's going to happen is once they go back and they say, okay, like in this case, it should be deemed to be covered, you're going to now have to prove your claim. How long did it take? How long was the implication, of the shutdowns? When did they happen? So you're still going to have a lot of argument over what the actual loss was related to COVID physical damage to your property versus and the civil authority and whether these sublimits apply. So it's not over, even if we get through some of the favorable wordings, but it'll just take some time. But I think it's going to be very frustrating. And unfortunately, I believe a lot of the companies that need relief as soon as they can, especially in the restaurant, hospitality business, and other things that are pushing hard for it, it may not matter based on the timing. Because if you recall, the Hurricane Sandy and whatever we called Sandy when it hit, that took 5 to 7 years in a lot of cases to get anything resolved. So it's going to take time to get through this.
And hey, Reed, real quick, for the example that you provided of the case that in North Carolina yesterday, was that for North Carolina coverage?
It will be. So you got to remember, insurance is state regulated. There is not federal regulation, so you're going to get a lot of push for that. So all these things, that's why the businesses and how they'll interpret it will be varied. So then a lot of them will go after favorable jurisdiction or favorable venue to see where they can get some of these things interpreted. But that is one of the problems that you have with this whole process is every state and even jurisdictions within states will have their own rulings depending on which court system that they go through. There's the federal court system has already kicked out anything that has come their way because of the way insurance is regulated.
Thank you. And Reed, let's stick with you for environmental insurance. This is one product that may pay for COVID-19 losses. The number and type of environmental liability insurance products has increased in recent years due to public awareness of environmental issues, active legal systems, and enforcement of environmental liability disclosure requirements. How are your clients evaluating environmental liability insurance products, and how are the underwriters packaging them?
So, environmental liability, there were several policy forms, not all, but there were several policies and carriers that actually had affirmative coverage for viruses and communicable disease. And the environmental marketplace had been filling the gap for things around Legionella and some of the other environmental exclusions that are on the general liability policies. So there's been a lot of research into those policies that did not have specific exclusions or had affirmative coverage. Going forward, I think you're going to be able to negotiate some of those things with other carriers on certain terms and responsibilities. The business interruption is going to be a harder trigger just simply because part of the environmental liability trigger is the cleanup period and time and loss of revenue during that period. So how far and how long, you don't have the civil authority trigger in an environmental policy like you would in a property policy. But there are things related, because what we don't know is how many times, businesses, and every time a company, when we finally do go back to work or the businesses are reopened, every time that they have a COVID break, you have to do certain things for your own liability security. And so those cleanup costs or expenses and driving into your business could be picked up under some environmental policies. I don't expect that the carriers that have continued to offer those viruses, the affirmative coverage, will do it on just a throw-in basis anymore. I think it'll be an endorsement with sublimits, but you'll be able to get certain things. I still think you'll be able to get certain things for specific industry groups.
Oh, okay. Well, Steve, active claims and high unemployment are having a major impact on workers' compensation. Premiums are based on payroll, and decline in payroll will drive a reduction in premium revenue. The decline in GDP, market volatility, and interest rates staying lower than expected for longer than expected will impact investment returns. How do you see this playing out for renewals?
So when you look at the comp market, it's one where the actual rate increases have been much more modest compared to the other lines. Absolutely the rateable exposures are down. The employment's varying by certain industries considerably, but we see that as being fairly stable going into 21 and not subject to a lot of change. Maybe certain appetites by carriers perhaps might be redeployed. But, when you look at some of the other pricing dynamics, property I was mentioning, I think when you look there on a reinsurance basis, not only are you seeing escalation of the rates, but the policy conditions are also becoming much tighter, more sublimits, that are being instituted relative to flood and other cat exposures. So, oftentimes in our industry, we look at percentage changes, and the flaw in that logic is that you really do have to make an adjustment for both terms and conditions and what that impact is. And so both are moving adversely from the standpoint of the buyer, paying more rate for less coverage when you look at tightened conditions. And that's something that we're seeing in property, definitely seeing extensively there, seeing it in casualty. In terms of property and its responsiveness to any cyber losses and so-called, silent cyber coverage, that's totally been closed down, very much excluded from the ongoing policies. And the casualty market continues to be very challenged. It's based on the actual frequency and severity of claim events, that it seems to be on a national scale now, not just confined to certain tort venues, and the escalation or social inflation in these verdicts is just mind-boggling in some cases. And so the knee-jerk reaction there is to pull back capacity, right? So in many cases, increased rate is not the answer. And I guess the final point is you have to really look at how far rates really went down over the last 10 years. And so we are seeing some, sharp escalation from the lows, but in the view of the reinsurers and the carriers, and I, used to work on that side, they see that they're still not there for rate adequacy. So they're going to be pushing significant rate increases, moving off certain accounts that are loss affected or tough exposures, and it really creates a challenge for the buyers. I think it's really incumbent on the brokers and others to talk to them frequently in this process and help them understand the change in dynamic. And more data is required in these submissions. A much more sophisticated level of loss control analysis on industrial accounts is very much required. Bringing in third-party engineering firms, that sort of thing, to get the time and attention of the underwriters who are just swamped with submissions. And the shotgun approach of hitting the entire market with a whole series of submissions, that's not working. It's more of a rifle approach. Buyers that start early in the process, they have quality data, and a compelling story. And definitely we're seeing across the board a real increase in interest in captives. So definitely there's a lot of new formations underway as a result of all these factors. Buyers are seeing that there's a real opportunity to retain some level of risk and attach higher in a program and control their outcomes. And so that's definitely a shift that's underway, particularly in property. Just incredibly busy right now with a number of new projects in that regard. So very dynamic market. It's one where, I think COVID, I guess when you look at that, it's in my view, what we're seeing now is probably a 1 in 100-year event, and so you have more the smaller events are going to be recurring, but maybe to some extent there's some parametric products that come out to address that over time, where they'd have a pretty broad payout feature based trigger based on World Health declarations and that sort of thing, that could provide some level of cover to the buyer that traditional may not. I know there's a couple large global reinsurers currently working on those projects right now, and I think that's very compelling. So I think to some degree the market will respond, and maybe on COVID, there's a governmental backstop that emerges both here in the U.S., the EU. It seems to be that kind of risk that suggests that's the way to do it and syndicate it. So I'm throwing a lot out there, but I'll stop there. But those are some of my general observations.
Yeah, thank you. And Steve, let's stay with you. What do you see as the drivers impacting the state of the U.S. medical professional liability market? AM Best published a negative outlook for 2020.
Yes, that's a variety of factors. Overall, healthcare utilization's up, so that's going to be driving the exposure base. Certainly, you look at the tort environment, that's a key part of the dynamic when you're looking at medical professional, that there's a lot of, quite frankly, defensive medicine that has to be done to, shield the insured from litigation, and there's a cost to that, so that drives the cost. But that said, there's still considerable amount of plaintiffs' bar activity in that space. It's particularly acute in some venues and some jurisdictions, but it's a very tough model, and I think the risk management that goes into it is superb. It's evolved considerably in the last 10 years, and I think the frequency side of it, I think, is becoming much more controlled. It's the severity that's many times unexpected, and so it's a tough space. And that's another one where you're not seeing a lot of capital coming in to it. It's claims-made business, which helps a bit, but the reality is a lot of those underlying covers are extended. They have tail coverage, and it's almost occurrence-like. But it's a very aggressive plaintiff's bar out there. Anything that's medical-related, and both the treatment side and certainly the pharmaceutical side, the products, is front and center in that dynamic.
Definitely. Several times throughout this discussion today, the term cyber has come up. Reed, the demand for cyber insurance policies is on the rise as we're working remotely and the concern of cyber threats growing. How is this impacting your clients?
It has become very problematic, especially in the phishing schemes and some of the other things. We had a Fortune 500 client that actually, and I'm not going to relay who it is, but actually wired $3 million through a phishing scheme and claim. We've had $60 million ransomware claims. We've seen it. So everyone that's working from home has allowed for easier access to folks' email systems and everything else. And I think one of the things that people believe, that everyone not believe, but one that has to be understood is what's happening in the cyber attack world is they're not attacking, i.e., a Johnson Lambert. They're not attacking a McGriff. They're not attacking something. What they've gotten so sophisticated in is they're sitting in behind the scenes, looking at the various connectivity and the open gaps that may be between software platforms that companies are operating off of, and how they either don't lock themselves down or sit out there when they think that they've taken them off their systems and they've become vulnerable. And once they get in there, then they start to send out the ransomware or start to send out certain things. And, oh, by the way, it may be a real estate account. It may be a healthcare account. It may be an accounting firm. So it's becoming very sophisticated. And again, it's not directed specifically at certain industries. So what that means to me is that it doesn't matter what your industry is. Everybody is vulnerable if you're operating with certain types of platforms, and we can't even tell you what those, you can't really know what they are if you haven't put the patches in or done certain things. So it's becoming very problematic, but clearly, it used to be, even a year ago, you could you would get the phishing schemes, but if you looked up at the name or whatever, you'd see a letter off or something. But today, they may get in your systems and use your email, and are very, very clean. So it's becoming harder and harder. And when and everybody's trying to work quickly and work remotely, and they can't walk down the hall and talk to their treasurer, or somebody's on a call for 30 minutes and they feel like they need to get it done that sounds reasonable. We're seeing more and more of that. So it's a real problem. And thus you're seeing, and what I mentioned early on, the cyber market taking a deep breath and going, oh, wow, where we were thinking, where things have been declining in premiums, or, they're building their legacy and their loss reserves, now are starting to look to 5-20% increases and deductible challenges as well.
Yeah, I would just add to that, everything Reed said, I agree with. We're definitely seeing the penetration of the products in terms of purchasing is definitely increasing dramatically. It's, I have a client that's industrial B2B type client, and they had not bought cyber until about 2 years ago, and the motivation in their case was a lot of it's being driven by the supply chain itself. It's so interconnected. IoT is a big part of the dynamic now, and so I think a buyer recognition that the level of exposure in cyber is increasing dramatically. It's no longer the outlier event, to Reed's point. And I just think when you look at the dynamics, you've got certainly some state-sponsored activity and just high level criminality behind this with the dark web, and it's incredibly sophisticated. It's being run on a global basis. So, and to my earlier point, I think wherever there might have been some potential soft coverage for cyber, like in property forms, where it was a little bit quiet on that point, it's nailed down now where it's absolutely excluded. So if you have cyber risk, you must buy for it. And I guess the final point I would make is that I think there's a recognition that maybe some of the off-the-shelf cyber policies are, they're fairly generic, and if a company has a very high level of cyber exposure, increasingly they're looking to captives to access reinsurance to put something more tailored together, and all that said, there's a tremendous amount of cyber exposure out there at the company balance sheet level that's not insured. It can't be insured. It's they either cannot buy enough limits, or there's just not capacity for it, So it's going to continue. And, I think when you look at the trends like IoT devices, that the proliferation there, it's going to just increase the attack level within the companies.
Excellent. Thank you. And then I guess, when we think also about general liability insurance, Reed, are you seeing changes in the packaging of general liability policies, and what's the implication on pricing and renewals?
Packaging of the policies may be a different term, but what we're seeing is some significant changes in terms and conditions, and where even companies that don't have the exposure or didn't think they had the exposure, you're getting at some addressing the communicable disease exclusions. We're addressing certain things that that are happening in and around the social inflation. You are seeing a lot of primary programs, due to the excess attachment points, being forced to place $2 million or $4 million primaries versus what has historically been a 1-2 limit. For 25 years or 30 years, it's been kind of the average is 1-2, which in today, just through inflationary issues, $1 million limit is just become problematic and pretty run-of-the-mill type claims. So you're seeing changes like that are adding cost into the programs, because a lot of the primary GL carriers, and you can use the Travelers, the Hartford, the AIGs, everywhere else, they are not buying their reinsurance thinking that they're going to need a 2-4 going into this year. And then when you do it, you have to price it, and Steve can probably address this better than I can, in the facultative market, which is a spot market, which is going to be significantly higher price. So when you buy that buffer, you may be paying more for that $1 million extra one layer than you were paying for your primary layer, just because it's opportunistic and there's not an efficient marketplace to buy it. That'll change, but that is something, and we've talked about certain industry classes that you're going to be really forced to do. And if you've historically used a risk purchasing group of some sort for your excess, many of those are requiring even higher attachment points, which means you're going to have to get a primary layer to get in front of it because they just can't afford to take the hits in the capacity in which they've had historically priced. So, there's a lot of challenges that are going to be around the GL, and again, we use that term social inflation has really driven us into it, and the liberalization of a lot of terms and interpretation by the judicial system. So it's not every industry is going to be faced with that. There's still some that are a little more benign, but if you're in the hospitality, you're in the transportation, you're in the things where there's a lot of public domain, the retail segment where their people are coming around and the responsibilities, you will see some significant pressure on your programs.
Yeah, I would add to that on the reinsurance side. All that definitely applies. We're seeing real contraction of capacity. Renewals rate increases 35-40% for loss-free accounts. And by the way, that's oftentimes a disconnect with the buyer. They may have really no GL claims the last 5 years that they're seeing non-renewal or a double-digit increase, and they just what's going on here. Their experience doesn't suggest that, but it's being exposure driven. So there's two things in rating: you got experience and exposure. And the exposure side, all the factors were around social inflation, but also around emerging risks themselves. There's an annual basis, a redefinition of what these emerging risks could be and how they could affect particular industries. And so each renewal, I'm tending to find a new discussion theme comes up in that regard. And, it's a very, the higher level excess is really dried up. And and that's a disconnect where a board may be used to having 150 million tower. They might only be able to get 75 million in this market. Or be looking at an increase that's 2x of what they were paying, and it definitely limits are coming down, and I think there's a general concern with reinsurers that rate adequacy is not remotely there yet for excess casualty, and they're going to continue to push double digits into the next several years, quite frankly.
I'll share a real quick analogy on that. Now, I know we're running short on time, but we had an underwriter that we were dealing with a gaming. He says, you understand gaming insurance is a little bit of a gamble, all the things that go through because you're pooling your resources. And he says, so when we sell you $1 million limit for $2,000, we're at 50,000 to 1 odds, right? Because go look on your betting gaming board and see what the highest odds you will put on something. Historically, it's never more than 2,000 to 1, typically in the hundreds to 1. So you're asking us to gamble, and it doesn't take many losses of the 50,000 to 1 odd to not ever have a payback scenario. So that's the attitude that they're taking.
And I've been trying to monitor our questions and get those answers throughout the discussion. If we don't get to any of the questions, we'll follow up with you after. One of them came in about the reception by reinsurance carriers to organic versus M&A growth techniques. I guess, Steve, would you be able to comment on that?
Yeah, I guess when you're looking at M&A growth, as long as it's in a common industry where the company has demonstrated an ability to execute, there's really not a concern about that. Uncorrelated M&A, I think, is always going to be an issue in terms of execution risk. I think all that said, probably a preference towards organic growth, and very much pure analysis on both sides, so companies are going to be benchmarked against their peers on a variety of metrics, and this is all happening behind the scenes of financial, M&A track record and so forth, and so I guess M&A is fine as long as it's done prudently and there's minimized execution risk around what they're getting into.
All right. This brings us to our second polling question. Have you increased pricing for policies? Yes, minimal amount. Yes, significantly. No, or the last option, not applicable, or Johnson Lambert employee. Again, please remember to press submit to get credit for attending the webcast if you're searching for CPE or CRE credit. We'll give it one more second. Have you increased pricing for policies? We'll go ahead and show the poll results. So yes, the minimal amount. Steve and Reed, this brings us to our next topic of navigating renewals and dealing with feature restrictions and condition changes. So Reed, we'll start with you. How has the application process changed, and can you give us some examples of what you're seeing related to policy exceptions?
A couple of things, and we've kind of touched on this. One, there's so much activity in the market that the better information, the better detail, the more that they need in order to not push it aside and work on something is becoming very much an issue today just because of time and capacity inside the underwriting. There are also a lot of things around your financial conditions and ability to take retentions because they're pushing deductibles. So an evaluation of your financials is becoming, even in the smaller guaranteed cost business or on risk transfer, because they want to know that you have the ability to do some of the things to sustain your business and not just and cut back on life safety or other things that could have an impact on your employees or your customers or your business in equipment maintenance or things that you're going on. So there's just a lot of things that they're looking at across the board that we historically have been able to avoid. Deductibles are definitely being challenged because it's a way to mitigate price increases where you take on more of the risk, but sometimes people don't evaluate, or there's not enough data to really give you a significant loss pick, but they're looking at it on a book of business basis, and it's harder on an individual account that only may have one or two claims or no claims to understand what that move in a deductible may have on their financials. So those are the things that we're dealing with in the application process and the data process. And what I'd also tell everybody that's involved in their insurance renewals is to get started very, very early. Make sure that you understand exactly what's needed, spend the time, get the stakeholders in your business involved in it, but expect it to come down to a very last-minute late renewal on if you have a complex risk or have something that has a lot of risk financing involved, just because of the time to get things done is exasperated by both the work from home and the fact that there's so much volume in the marketplace.
And so, Steve, we discussed macro reinsurance trends earlier, and how are you seeing these translate into reinsurance agreements? And this ties into one of the questions that was just submitted is, have mandated communicable disease exclusions being included in reinsurance contracts? Is that a common thing that you are seeing?
Yes, very much across the board, and also I'd go as far as to say in some seemingly innocuous accounts, frankly. But all the reinsurers are in lockstep pushing that wording in the contracts. I guess in terms of as mentioned earlier, some of the overall conditions, definitely there's contraction going on. Sublimits are more aggressive. Some wording changes specific to certain industries are seeing a lot of pressure there. Products liability exposures, certain, products and chemicals and processes are being so named, as excluded outright. So definitely that's, the phase of the market we're in where you have contraction of the policy form for a higher price and just in terms of the reinsurance placement process, all the points that we mentioned, I agree. It's you must start early. It's very data driven, very tight data. We see reinsurers that want to speak with the client along with the broker. They really want to hear the story from the if it's a captive owner or the management of the company. What is the strategy? Where are you going? And a lot of activity around losses. So losses that seemingly seem small, say a $25,000 property loss, they will drill into that now as, is this representative of something that could be bigger? Is it a systemic type issue? So we really have to come out with, for where there's been losses, what are, a post-mortem, what are the lessons learned, what's being done differently? And, loss control survey reports, that in the depths of the soft market where oftentimes, just slapped together, that doesn't fly. It's got to be very deep, looking at processes, allow them to run their independent models. Going on site, we're hearing a lot of requests to do that. So you have to have time for that to get them into a plant location. And so it's a very, those that have the start early with strong data compelling story and a great strategy on the renewal, what they exactly want to buy and for how much will do well, and there's a lot of last minute reaction out there too, where suddenly it's, gosh, I'm being not renewed, and they want, 100% increase, have 200 million limit. I can only get 40 this year. Stories like that you hear out there anecdotally. And so, that's, it's a much tougher dynamic for the brokers and the buyers. They're going to have to be much more involved in the process.
Yeah, and I think, there's 390 or 400 people on this call that have different businesses in different places. So I think it's understanding your business and what the implications are, because you probably will be surprised with communicable disease exclusions. If you have flood exposure, you're going to see sublimits and not just deductible increases. And there's a lot of things that you need to be able to understand early on in the process. Is the things that I used to get all the time that I may not get anymore. Do I need them? What are my trade-aways? So those are important.
All right, great discussion. Now let's move into captive insurance. So Steve, captive insurance solutions can be seen as a way to create capacity and lower costs. Interest in forming captives was already strong before the pandemic. What is fueling the captive discussion?
Yeah, I think a lot of ways, the buyers are seeing the captive as beyond just a hard market tool. They're looking at it as a long-term risk financing tool. So, when you look globally, captive penetration for the past several years has been increasing. And, but I think definitely with the hard market, it adds fuel to that. There's a much better risk-return trade-off to retaining risk in this kind of market. So, it's very compelling to have a formal vehicle to do that in. And accessing reinsurance directly has a lot of appeal now to, I think a real strong tendency or desire is to have a syndicated layered placement versus having one carrier providing 100% because they all recognize the difference, the risk around that. And I think the level of captive, sophistication in industry has increased tremendously. It's 20 years ago when I was involved with captives, it was more of a cottage industry. I think now it's a main integral part of a risk strategy, for not only Fortune 500s, but, small and medium-sized enterprises, SMEs as well, are very active in captives. So, definitely, and I think the key motivation is there. You have to really look at, why do you want to form the captive? Is it part of a long-term risk strategy? That's always the answer that I want to hear. It's if it's just a reaction to market pricing, that's probably not going to be worth the exercise of forming the captive. But we're very active with some really high-quality companies coming into the captive space, and some may use it only for funding the deductible. Others may want to access reinsurance, but it's part of an evolution in my mind.
And Reed, we've got traditional risk purchasing groups are getting crushed. Are you seeing clients looking to form captive as part of their risk management strategy?
Yes, and I think there's risk purchasing groups that have allowed you to buy a lot of limit cheap and for volume and access points where people have cut capacity, but now they're looking at group. I think the risk purchasing group can come in a lot of different forms, and where it be association or as a captive base behind it to allow group captives and similar industry groups of people that know each other to participate, and those are becoming very prevalent and are growing in the attractiveness of it because they can then manage and monitor. They are longer term. You have to think about it as a much longer term solution and not just a year. I can get in, get out, because there's a capital commitment that you need to participate in because you become part of the ownership group of the risk purchasing group or the group captive, so to speak. And those things, but they're great tools if you have good process and you know who your partners are, and there's great discipline around the underwriting, and you have a long-term view of it. With the advent of so much M&A and private equity, if you're in the business of thinking you're going to sell your business or something's going to be done in the next few years or whatever, then it's probably not a great solution. But, if you've got a long-term strategy, then it's something to definitely look at.
Yeah, thank you. All right, let's move into our third polling question. Have your reinsurance policy terms been modified, or are they expected to be modified? First up, I don't know why that happened. Okay. First option, yes, significantly. 2, yes, a little. 3, no. Or the fourth option, not applicable, or Johnson Lambert employee. Again, have your reinsurance policy terms been modified, or are they expected to be modified? Please remember to select submit so that you can get your CPE CRE credit. Let's go ahead and show the results. We've got yes, a little. And I think we're coming close to time, but Reed or Steve, any quick comments on what you're seeing for your clients' policy changes? I know we've been talking a lot about these in the last section, but does this align with what you'd expect?
I would like to, I think maybe we should have defined what significantly and what little mean. In our world, I think, I think there's, and I noticed it on the previous polling question that there seems to be, smaller implications or feeling that they were smaller. And I guess that's a matter of perspective. Some of the things that we're seeing, I would suggest that, it's probably somewhere between little and significant, depending on class of business and certain things that are going on. But there will be modifications. So those, I'm not sure where the no came from, but maybe there won't be for some people, and it'd be interesting to know.
All right.
Yeah, I agree 100%. I think the no in the reinsurance side would be maybe 5% at most, but it's, I would agree 100% with what Reed said there.
Great, thank you. So Reed and Steve, as our audience prepares for renewals, what in addition to starting the process early should the audience be doing? And Steve, you want to start?
Well, I think, the starting early we've talked a lot about. I think, the renewal strategy, probably the first thing I'd recommend is, have a midpoint stewardship meeting with your broker. So, the tendency has always been traditionally, let's look at renewing the reinsurance or the insurance a few months out, and life goes on for the other 9 months. But I think that's, you need a midpoint, to gauge the market from the broker, look how responsive the program is, how claims are coming together. Start looking at some new product offerings out there. That's going to take some time to model and prepare for. So I would say at least 120 days out for a reinsurance renewal, it should start, and even more than that. Just if you have to run cap models, look at new offerings, as I mentioned, that takes time. And underwriters are slammed. They have so much to do right now that you really have to come in with a real well-honed submission to get their time and attention, and then you'll get it renewed.
Reed, do you have a quick tip?
Yeah, the retail side, I would also make sure that you have all your stakeholders that need to be involved early and understand that they may need to some participation. That could be ops, that could be senior level financial people to understand the financials and things that are going on. And a lot of this is going to be driven by the unique nature of your risk profile, size of company, and some of the other things that go on. But, one of the things, there is a commodity component to our business, which is an insurance company. But if you start treating it like a commodity all out, then, you may not be able to differentiate yourself from the market, because they'll fight back to the same degree. So being able to differentiate your business, the proactive measures you're taking, and all the things in the story around your company are hugely important to understand. And if you have had loss experience or history or issues, what you've done to mitigate, because those things will, when they do put it into their models, will kick things out right away. Or if they don't understand. And one of the last things I would tell you, just as if you have some embellishment on your website about things you do or don't do or whatever that may not be down the middle of your business, and we see this a lot, and it drives questions as to what are they doing in this area. Be sure that you look at your own website to understand what you are portraying to the world, your outside customer world, because the underwriters are going to go look at that as well. And so they're going to have questions about it. So understanding how you're portraying your company, you need to make sure that you can explain that to the marketplace.
All right. Now for our fourth and final polling question, how long do you feel the current market conditions will impact the P&C insurance industry? First, through the end of 2020, second option through mid-2021, third option through the end of 2021, and then the last one is into 2022. Again, please remember to hit submit if you want CPE CRE credit. How long do you feel the current market conditions will impact the P&C insurance industry? All right, we'll go ahead and show the results. Looks like most are saying into 2022. I know we're hoping everybody wants to get back to normal as soon as possible. I guess, John and Reed, any thoughts on the poll results as we close up the webcast?
I think they hit it.
Yeah, I would agree. Maybe in 22 you might see a little bit single-digit increases as opposed to double digits, but it's going to continue.
All right. Thank you both, Reed and Steve, for presenting on this webcast, and thank you to all of our participants for joining today. We hope you found this information useful and enjoyed the presentation. Please join us for our upcoming webinars. First one is, Are You Poised for the Workplace of the Future? That's occurring on November 11th. The registration link to this webcast can be found in the Resource Center. And then the next one we have is 2020 GAAP Accounting and Tax Update on December 10th. So please consider joining these webcasts. We've got a contact information for our presenters today. And feel free to reach out. If you have submitted some questions through the platform, we will be going through and attempting to reach out and answer those for you. And thank everyone for listening.
Thank you.
And that'll conclude our webcast.